So, quick introduction. I'm Barry Dowsett. I'm the founder and CEO of Myriad. Myriad specialise in creative tax relief claims. We are made up of a bunch of tax experts, BFI experts, and we're here to help you along your journey of making a theatre tax relief claim. Now, the purpose of this webinar is related to the fundamentals of theatre tax relief, but we will touch on SPVs and talk about how you can maximize your claim. There'll be a short part on that, so please stay tuned. Thank you for your time. As I said, I'm the CEO and founder of Myriad, and I specialize in the corporate structuring and tax elements of creative tax relief claims, and obviously supporting and the leadership of the team. I'd like to introduce you to my colleague Chris, who will quickly introduce himself.
Hi, I'm Chris. I'm the Tax Incentive Manager here at Myriad, and I specialise in the creative tax relief area. I've been doing that now for about 8 years with Myriad, dealing with a whole vast array of different sizes of clients, different sizes of claims, claiming back tens of millions over those years on behalf of our clients.
Fantastic, Chris. In terms of questions and answers, we will have a session at the end of this webinar. So feel free to add your questions in the Q&A section, which hopefully you'll see at the top of your screen. And we'll try and get through as many questions as we can. We've had a few that have already come through. We've got those already lined up to be answered. So this webinar should, in terms of the actual presentation, should be no longer than 30 minutes. And then we'll have roughly 15 minutes to answer your questions. Now, if we can't answer your questions, we get far too many, don't worry, we will respond to you directly via email. So let's talk about what we're going to run through today. So the agenda. We're going to kick off with some of the fundamentals, which is what qualifies, so what productions qualify for theatre tax relief, the type of organisations that can claim. Chris is going to run through the production phases with you and identify the areas where you can claim whilst you're obviously running through that production. He will touch on the core production expenditure. He will then switch across to myself, and I will touch on some of the most important areas is actually how much is it worth and how we can ensure how each production break even, that is to ensure you get your full entitlement to theatre tax relief. And we'll end up with looking at the claim process and timelines. And finally, we'll jump on to the Q&A session at the end. So it's definitely worth hanging around to find out how you can ensure you maximize your claim. As I said, I will touch on that further through this webinar a little bit later. So I'm just going to hand the slides across to Chris, and Chris will kick off.
Hi, thanks, Barry. Okay, then. So obviously, one of the biggest questions I get asked is what does qualify for theatre tax relief and how do we know if we qualify? So it's aimed specifically at plays, operas, musical and ballets. So what they mean by that is that it's got to be a piece that tells a story where the performance is alive and the performers are giving that performance through playing a role. And that's the main essence of what they deemed to be theatre. Now, it can be ballet. Interestingly, ballet is the only dance that qualifies for theatre tax relief. It can be modern forms of ballet, but it must absolutely be ballet. The actual production itself is intended to be live to audiences of 5 or more, ideally to the paying public, so it should be a ticketed one. There is an exception to that, which is if the actual main intention is to provide it for an educational purpose. And by that, for example, a charitable theatre production company whose main objective is to actually educate on that particular charity or the aims that the charity covers across may actually qualify if they're performing live, say, to a school. So that would still qualify without being ticketed. The audience's main purpose must be to watch the performance. So this again ties into what's deemed as a qualifying theatrical production. And there are some exclusions to what qualifies. So things that are specifically for advertisements, competitions, in-house training, or anything that contains strong sexual content or wild animals would also be prohibited from making a theatre tax relief claim. So that's the types of productions that qualify. Next, we're going to look at who can claim. Now, obviously, theatre tax relief is a tax incentive for businesses, so you need to be subject to UK corporation tax. And sorry, just to clarify, by businesses, I mean anything that's actually got a registered limited company or falls under the UK corporation tax net. Now, there can be only one company that claims theatre tax relief per production, so only one will be considered the theatre production company. It's possible that you may be in a co-production. You may have a few companies that are actually participating in pulling this together. However, only one will qualify as a theatre production company, and it will be the one that most meets the following criteria. So you need to be responsible, and mainly responsible for producing, running and closing the production. So all phases of the productions you need to hit on and be active in all of those stages, including giving a creative, technical and artistic contribution to those. So in other words, it's no good if you just literally go to someone, put on this theatre production for me, you go away, you make this theatre production, will be the theatre production company. It doesn't quite work that way. The company must be responsible for those stages and must be actively involved in that. And those costs need to be going through that company too, because they need to be the company that is directly negotiating the contracts with those individuals. So the money must also be passing through the theatre production company for it to be eligible and for it to be eligible expenditure. So there are other different types of performances that may qualify, so I wanted to touch on these as well, so that Barry will talk through the rates in more detail. There are touring productions, and a touring production will actually get a higher rate of relief. It'll get 45%. Your tour details will be required as part of the additional information form, so they'll want things like number of performances, the date and location of each of those performances to qualify for that higher relief rate. And to qualify as touring, it needs to be in at least 6 different premises, so shown either in 6 different premises or 14 performances shown across 2 different venues. Those are the criteria for being a touring performance. A lot of questions we get are about immersive theatre. Yes, immersive theatre can absolutely qualify so long as it meets the other eligible criteria as a theatrical production. So once again, so long as people are there to observe the performance and actors are playing a role, and that's the main function of the audience, is to observe that performance, it would absolutely qualify. And likewise, community and educational shows will also qualify. So for example, a community show where the costs are being run for a limited company, so long as the audience members are paying audience members, that will qualify. Or if it's an educational show, as I've already touched on, that will absolutely qualify as well. The intention must be for it to be educational from the outset, for it to qualify as an educational show. It's not something you can claim after. It must be an ongoing intention during the production phase of the piece. So next, what phases can we actually claim? So as far as HMRC are concerned, they split the whole development of any production into 4 phases. So they talk about the development stage. Now, the development stage isn't qualifying expenditure. It's where it's seen to be speculative. So at this stage, you're trying to work out whether or not it makes commercial sense or feasibility to actually put on a production. So at this stage, there's no intention actually to get it live and get it in front of the audience. So that's considered speculative, and those costs at that stage are not qualifying. Once the intention has passed and you're into what's referred to as normally producing or pre-curtain up production, the key phrase that HMRC uses is that it's been greenlit. The intention is now that you are going to make this performance happen. Now, obviously, that's going to be different for everyone. There's no hard and fast rule about whose intention that is, but there should be some kind of evidence to back that up. So there will be some evidence to say that's in place. So there's a clear intention. You've got everything lined up. You're now going ahead. There's a real commitment to make this. So you've probably got your financing in place, etc. And it's this stage that most of the costs are actually eligible. Some of your development costs at this stage could be reclassified into production, especially if they relate directly to latter production activities. So everything from the stage we say we're going to make this claim, we're going to make this production happen, up to the point of curtain up is the production, core production for this. As soon as the curtain's up, you enter into the running phase. So the running phase, typically, those costs are now not eligible for tax relief. They're not considered core costs. There are some exceptions to that. So it's possible if you've got exceptional running costs that you could pick up on that. I'll cover that a little bit more in the next slide. And the last phase that's actually allowable is the closing stage. So once the curtain goes down on the last performance, the cost for striking the sets, bringing it all down, wrapping it all up, all of that would also be qualifying expenditure at that time. So what are the things that we can actually include in the core production expenditure? So as I said, it includes the pre-running production phases and the closing phases. So everything you see on this slide. So staff costs for actors, production costumes, script, royalty rights for those particular, if it's a particular play we have to pay to actually use that, absolutely that would be included. The entire cast and crew and their rehearsal times up to the curtain going up, including set design. Now, some of the things that people often forget at this stage is you may also have overhead costs that you can actually bring in as well. So say, for example, you're renting an office space, where you can apportion that office space as well, so long as it, for the phase when you're dealing with the actual producing of the play up to curtain up. So that would all be allowable under this scheme, and that's a section that many clients have missed out on and have underclaimed because of it historically when I've picked up and looked at their historic claims. And the other thing we can also include here are exceptional running costs. So these are things that wouldn't normally happen during the live phase. So for example, if there is a significant major recasting, so for example, recasting of lead actors could be considered an exceptional running cost, as would be a complete set redesign. That can also be considered an exceptional running cost. However, general repairs and maintenance to sets, or changing of background cast or background performers would not be considered an exceptional running cost. They're just considered normal running costs for this stage, so those wouldn't be eligible under this scheme. Okay, and now I'm going to pass over to Barry, who's going to talk you through how much this would be worth.
Hi everybody. So this is the bit you've been waiting for. How much is theatre tax relief worth? So Chris has mentioned about what is the total core cost, the core production costs. And what it's actually worth is, in terms of the extra enhancement you get, is 80% of those total core costs, or the amount of eligible costs, whatever the lower is. Let's just assume, in our examples, it is that the eligible core cost is 100%. So you take those core costs and you'll take 80% of those, and that is what you're enhancing. That's the amount of money that you're reducing your taxable loss or profits by. Okay. Now, interestingly, HM Revenue and Customs allows loss-making and break-even companies to receive cash at a higher rate than what the corporation tax savings are. And I've given you a couple of examples on there in terms of how the calculation works. So a profit-making production, where it's core production cost, you get that 80% enhanced. Okay, I'll go through some numbers in the next slide. You then save at a corporation tax rate between 19%, which is a small company's rate, and then that goes up in terms of tapering up to 25%, which is the main corporation tax rate. So they're basically getting 19 to 25% on 80% of their production costs. Interestingly, a loss-making business or break even can get the higher rates, the headline rate that we all talk about, the 45% for touring or 40% for non-touring. Of course, you still got to apply the 80% rule. So you can see here already that if you've got a break even or a loss-making production, it's actually worth more money to you, because you're actually getting cash and you're getting it at a higher rate than what you would if it was profit-making, i.e. corporation tax rates. So the next slide that I'm going to provide you with is one which talks about how much is it worth in numbers. The top is what it's worth for profit-making production, and the table below is for loss-making or break-even production. So in a profit-making situation, your production is profit-making. It really doesn't matter if it's touring or non-touring, because the rate itself, because it's a corporation tax saving, and all companies pay corporation tax rates, pretty much the same, either 19 or 25, you will see that in this example, £100,000 of core expenditure, you end up taking 80% of that, because that's the restriction that is applied by HMRC and Customs, and you'll get somewhere, once again, depending if you're a small company rate or the main rate, 19 to 25. So you physically save in corporation, i.e. your corporation tax reduces by somewhere between the 15,200 to 20,000. And that's simply taking your 80% here multiplied by 19 or 80 multiplied by 25. And that's the same for touring and non-touring. However, this is where the government are giving loss-making and break-even productions an advantage. You're actually getting a lot more. So touring and non-touring, this is where it does differentiate. Touring, you have the 100,000, once again, it's the same spend. You get the 80%, which is the enhanced amount. But then you apply the gross amount, the 45 or the 40, to the 80,000, and you end up either with £36,000 or 32, and that's significantly more in terms of receiving cash, that's a payable tax credit, than it is in terms of your corporation tax. So the next question is, how do we make sure that all your productions are either break even or loss making? And I'll get that onto the next slide for you. Okay, there's this wonderful thing called an SPV. Special purpose vehicle. It's a lovely word made up by a load of solicitors and accountants, but in very simple terms, a special purpose vehicle is a separate legal entity, typically a subsidiary, that's registered for corporation tax. It's created for a very specific narrow purpose: to isolate financial risk, manage assets, or complex transactions. But in its very simple form, it is another legal entity. Okay, but it has this, as I said, narrow purpose. So in case of theatre tax relief, its purpose here is to have and to run a production. It's your production company for the purpose of TTR. And therefore, you're able to create that subsidiary, and through some legal framework, you're able to recharge costs from the parent company to the production company, and at the same time, the parent company is going to commission the production company to put on this particular production. So if you think about it, we actually have the parent company that is charging costs. Commission is going back from the production company, charging back up to the parent to get it into that break-even position. You think, okay, fine, the parent's going to have some income as well. How's that going to work? Production company's got third-party costs as well. Well, yeah, I think if you go back one slide, this is quite important, what you're achieving here is, yes, the parent may be paying corporation tax at 19 to 25%, but more importantly, you're actually receiving a larger benefit. So you actually gain the difference between the TTR and the corporation tax. So always aim to try and get to a break-even position. Now, this is something that we help a lot of our organisations with in setting up special purpose vehicles, that wonderful word, special, because it's got special rates attached to it, normally from solicitors and accountants. So in order to set up an SPV and for this to work in conjunction with the HMRC and Customs guidelines on TTR, and also for the creative unit in Manchester, for them to obviously understand and work. And it's a great way for an SPV is to take your costs and basically you're ring fencing them, but you're also making it clear from an accounting point of view, which HMRC and Customs actually like. You need to have certain documents in place, and a working capital loan agreement is one of them. So that's you, the parent company, giving the production company some money to be able to start to incur costs, contractors, staff, etc. It's also possible that you will have a situation here where some of the costs may come from your parent company as well. That is allowable. But let's not forget the production company, back to the original framework that Chris mentioned, the original part, and that is that they are responsible, they've got control, responsible for running, etc. That must be important. And that's when it comes into the production agreement. So production agreement is about making sure that your particular subsidiary, your SPV here, is responsible for decision making and running and contract negotiation. And that also includes in the production agreement is the commissioning arrangement, i.e. is going to absorb the costs of the production company. However, the parent's commissioned it to put that performance on, and therefore it's going to invoice back the parent company. And to underpin this arrangement, you need a transfer pricing policy to ensure that any transactions are at arm's length as part of the OECD guidelines. And also you need to document the actual transactions and have evidence of that. And then, of course, if the parent company is providing management, admin and other services, it would obviously need some agreement to explain exactly what services it is covering. You can sometimes incorporate that into production agreement. We prefer to keep it separate, though, in case you have multiple productions. But yeah, so SPVs, special purpose vehicles, simply are a subsidiary legal entity and provides a mechanism and something which HM Revenue Customs favours because it makes the accounting records nice and clean, and it's something we certainly recommend because it gives you the extra benefit. Okay, now I'm just going to move on to the next slide, which is talking about the claim process and timelines. This is generally how it operates under normal conditions. So to start with, you would need to prepare what we call trade schedules. So that is pretty much a mini profit and loss account per production. If you've got a separate entity for one production, great, fantastic. That's all taken care of. And basically, you're analysing your eligible UK core costs and showing the breakdown. These are the workings that support your claim to HM Revenue and Customs. There's this thing called an additional information form. So production title, the start date, breaking down the expenditure, information about the touring, if it's a touring production claim, and that has to be submitted before the company's tax return. So the mechanism of making an official claim is through the CT 600, which is the company's tax return, and that could be part of the original, or it could be an amended return. And you have a 2-year deadline in getting an amended return to HM Revenue and Customs. That's 2 years after the accounting period. And then once that's all been submitted to HM Revenue and Customs, and you've also provide them with the trade schedules in terms of each of the productions, they typically, this is in the Manchester Creators Unit, they typically take 8 to 12 weeks for them to pay out. At this moment, they're a little bit longer than that. They've had a huge influx, so you're talking somewhere between 13 to 17 weeks. But they will process the claim, and if it's a tax credit payable, they will pay you directly into your company's bank account. So that's the claim process and timelines. We typically say to our clients from start to finish, you're talking around 4 to 6 months from starting the process of preparing your trade schedules, etc. It can be done as quick as 3 months, and that is from starting the process, submitting the additional information form and the company's tax return, and then to physically pay you out from HM Revenue and Customs. Okay, so I think that brings us towards the end of the webinar, and we're now going to move on to, I think, your questions answered section. So I believe we have some questions, and Cal's just joining us. Cal's just going to put those questions out to us, and we're obviously going to try and answer them. Some of them came in before, and I think some have come along whilst we've been on this webinar.
Yes, first of all, thanks, Barry and Chris, for that very informative webinar. As we mentioned, we have had some questions come through in the pre-qualification sign up for this webinar. But I will also add that at the top of the webinar screen, you will see a Q&A box. So if you do have any questions, feel free to submit those and we can try and cover those. Some of the ones we did get in pre-webinar, I will just start from the top of those, Barry, if that's okay with you. And the first one we have here is, how can cross charges be optimized in co-productions?
Yeah, that's a very good question. I think the first thing to remember, and right at the beginning, we said that there can only be one production company. So where you have got a co-production situation, you need to ensure those costs go into that one production company, and that production company is the one that is making the decisions in terms of contractual decisions, responsible for the running. So that needs to be determined. So in terms of the cross-charging, obviously you will go for the one that meets that criteria, and the other company that's involved, the other co-producer, can therefore transfer costs. Now, if it's pretty much 50-50, what I would suggest, and I'll just go back to the slide here, is that and this is just from an organisation point of view, I suggest that you would have a co-venture. So both the companies can sit here and say, rather than being parent, that could be one of the co-producers, and you would have a production subsidiary where you have ownership in, and that ownership can obviously come down to a shareholders agreement, and the cost can filter through to that production company, which once again through the production agreement is given the right. So there's a couple of ways of doing it. One is simply you nominate and make sure through how the production is set up in the various agreements, where you've got the two co-producers invoicing into one company takes on the ownership, or the other option is you take a shareholding into the company and then you go to a production. So there's two ways around that, but yeah, remember it always has to be only one production company can make the claim. So structuring is extremely important. Okay.
Perfect. And another question we have here is, I will create a new company to support our charity. How can I move the cash into the new company without creating a problem and locking up losses? Does that tie into the SPV that you've just covered?
Yeah, it does. Yeah. So yeah, absolutely. So I think what's key in this is the special purpose vehicle, which is, as I said to you, is simply a subsidiary legal entity is created, and you would once again make sure the costs are incurred in that entity, and then you have that commission agreement that goes back. That's the solution for that one for sure. And being a charity, for example, or non-profit, you could always, as well, in terms of taking the TTR relief, you could always bring that back up by gift deed, which will bring it up as well, because you've obviously got to consider, but generally speaking, you'll go through the special purpose vehicle route for that, for sure.
Okay, I'm actually going to jump to one that we've got on the webinar now. Does the TTR still apply if the touring production is going outside of the UK? Is it prorated somehow for the amount of activity inside, outside the UK? That's from Lawrence Chapman.
Okay, I'll take that one. The simple answer to that is that you're claiming based against the production costs before curtain up. So if you're doing all your rehearsals and all your production costs actually happen within the UK, those costs still qualify. Any costs incurred outside of the UK will not. And to qualify, 10% of your production costs overall must be UK in order to qualify for the scheme. So the answer is, if it's just, say for example, you're putting on one performance or one show in Spain, as long as you're producing all that in the UK, that's fine, because you can't claim the running costs anyway in Spain.
Okay. Another one that we got pre-webinar. Can a company running an escape room style experience with actors and an evolving storyline qualify for theatre tax relief?
Ooh, I'll take that one. That's an interesting one, because as we said at the very outset, the whole purpose and what qualifies as a theatrical production is, the whole point is the audience is there primarily to observe the performance of actors, performers playing a role and telling a story. So when it's described primarily as an escape room experience rather than a show that people are there to watch, there's a chance that it might not. It's something that we would need to review in more detail to make sure, and I'd always welcome any calls after this just to chat through people's individual productions if they've got specific questions, because it is always done on a case-by-case basis. But the other interesting thing, at least from my point of view, for when we talk about escape rooms, is in the guidelines that HMRC actually give, they give a specific example of escape rooms not qualifying. So if it is primarily an escape room, and if primarily the purpose of the audience or the participants or why they're paying is to go through an escape room experience and actively participate, and that is front and center, it won't qualify. So the real question is, how much acting is going on, how much audience participation is going on? The acid test quite often is, how's this been marketed? How has this been sold to the general public? And that can be a really good indicator as well. And that's the kind of information we'd look at. If you'd like to, whoever's asked this question, if they'd like to reach out to me and share some more details, we'll go through it after this to see if it can qualify.
Yeah, perfect. And I think at this point, it's probably good to just re-mention the fact that your both email addresses are on the screen there if anyone wants to get in direct contact with Barry and Chris specifically. We're getting a lot of questions, guys, on the webinar. I'm not sure we're going to be able to cover them all on this call, but I'll just fire another one across now, which is when you are touring, are the costs of moving between venues TTR eligible, or are these regarded as running costs?
Good question. I would suggest that I would need to understand what they're doing, how they're looking at. Generally speaking, though, costs between performances and movements can be considered qualifying costs between the venues, more importantly. So that's what we would look at in that case. However, if it's expected the cost is going to be there for a certain amount of time, so if you're doing, for example, a 6-month run somewhere and you're putting the cast up for that, well, that's now a running phase cost. You're not striking the set and moving the set at that point. So the bits about moving from one location to another will be eligible, but once you're at that location, not so much. Once again, it can be very case specific and we would need to review in more detail, but just think of it whilst you're in running phases, no. But between those running phases, so show here, now let's move it all, that would be considered, in my opinion, a production cost.
Perfect. Okay, another one here on the call. Does the source of funding have an impact on who should be the qualifying production company? For example, if we, an independent production company, are funded by a cultural organization or venue, likely a charitable trust, should we or them claim the TTR?
It comes back again. So I'll start this one off, Barry, feel free to jump in. It starts off based on who's actually responsible for all the things we covered at the start of this webinar. So who's making the creative control decisions, who's actively producing the play, who's directly negotiating the contracts. Whoever does that the most should be considered the theatre production company. It could also depend on your contract and your arrangement with that funding body as well, depending on what you've signed up for. Did you have anything to add to that, Barry?
Yeah, as I said, we do get involved in quite a lot of what I call co-productions and also charities, etc. And I think, once again, to make things very simple and clear, to set up a production company as a separate legal entity, and then you can talk about the various ways that that entity is funded, whether it's through a co-venture, co-production, that kind of stuff. But yeah, make sure it's made clear in the production agreement which company is responsible for putting that performance on, and as per the criteria Chris said.
Perfect. Okay, we actually have a question that came through on royalties pre-webinar, and there's another one on the call itself now. The question we got beforehand was, do royalties qualify for TTR? And now the question we've got on the call is, can ongoing royalties to music rights holders form part of ongoing claims after opening? So maybe we could just touch on royalties there.
Right, yeah, absolutely. So I'll field that one again. So do royalties qualify? Yes, if they relate to qualifying production activities, because royalties can be a bit of a catch-all term, so we need to be a bit careful, and we can't really talk about them too generally, but if they relate directly to production activities. So let's give you some examples. So if you're paying royalties to an author for utilizing that piece of work, or to composers for their royalties, or scripts, etc., then absolutely that would be qualifying, as would any underlying rights that you're paying for intellectual properties and any other pre-production royalties that you may occur ahead of the shows. The types of royalties that won't qualify are actually running royalties, so royalties calculated on things like box office receipts wouldn't be relevant. Any post-production royalties, so payments after that for extensions, etc. So to answer that specific question that came in live, Royalties for an ongoing show once it's live, I'd like to understand in more detail what that contract is to see if it can actually be tied into the production costs or whether it's per performance and you're actually paying a running cost royalty. Because if it's a running cost royalty, it won't be. But I'd like to see the contract before I give a final answer on that question, because it will be case specific.
Okay. We have another one here on the call. Are any fees on advanced ticket sales for a touring show eligible for TTR?
Are any fees, sorry, can you repeat that question?
Are any fees on advanced ticket sales for a touring show eligible for TTR?
I would like to understand what those costs are, but typically no, because you're now actually talking about exploitation of the show rather than the production activity potentially. So I'd just like to understand the context of that a bit more, just to double check.
Yeah, I think just to add to this, Chris, I think it's actually you're talking about the ticket additional costs for booking fees, etc., and cost related for potentially for card transaction fees. So it's all related to the ticket price. So the answer would be no if that's the case. If that's the case, that would be definite no. It's part of the ticket cost of somebody procuring a ticket, nothing to do with the actual production itself, or certainly before it's greenlit.
Okay, cool. I think we've only got room probably for a couple more. And I am jumping around here, so apologies if I ask something that might have been covered already. But one we did get pre-webinar was, how does TTR work for ongoing productions and those post-recoupment?
Interesting question. Once again, I mean, as far as I'm concerned, in production phases, you can claim for exceptional running costs while the show's actually live. And as we've said, that's lead actors, any major changes to set design, etc. And the claim itself and your ability to claim is irrespective of the profitability of the actual show at that stage. However, as Barry's highlighted, depending on how you've set that up, can help you maximize the return that you get on those particular costs. Was there anything you wanted to add to that, Barry?
No, I think it's right, Chris. There's nothing to add.
Perfect. And then the last one here is, and again, apologies if maybe this has been touched on previously, but can I claim TTR if the expenditure is paid from a limited company account, but that account has been initially funded from my personal account, e.g. for upfront costs such as rehearsal venues?
Yeah, I can answer that one. The key to any TTR claim is that it's if the cost has gone through the entity, whether, i.e., if the person's purchased stuff privately and during when the entity was live, i.e., was incorporated, then providing the company is reimbursing the individual and it relates to a qualifying cost and an activity, the answer is yes. But once again, the company's got to reimburse that individual. It's almost treated like expenses. One of the questions is quite interesting, actually, just spot on that. One of the questions I normally get asked is that I've incurred some costs prior to setting up the a company, the legal entity. Can I make a claim on those costs? And unfortunately, the answer is you can't, because the entity itself did not exist. It was not live at the time. So it's very important, and this is coming back to the structure, and again, is that if you are going down the route of having a production entity under the SPV, is that you get that done as soon as possible. And what you don't want to do is try to transfer costs that have already been incurred before the entity actually became live, before it became incorporated. So that's quite important. Yeah, so generally speaking, personal costs, if the company's reimbursing, the company's live, not a problem.
Okay. And then just fire this last one across, which talks about scratch performances. So if we hold the scratch or work in progress performance open to the public, say in November at no charge, followed by further development and the official premiere in May 2026 with ticket sales, would qualifying expenditure extend up to the curtain opening in May 2026 rather than November 2025?
I'll take that one. I mean, the simple answer to that is yes. You would be able to claim the production expenditure from the scratch performance up to curtain up because you're still in the production phase. What's very interesting about that for me as a question though is at what point are you doing this scratch performance and what's the purpose of the scratch performance? So if the scratch performance itself is part of the development phase, the early development phase, just to see if this is an idea that's going to have ground, then that would be speculative, which is an interesting concept. However, if you've already made the intention, hey, we're really going to go forward, we're really going to push forward with this, it's greenlit, and then the scratch performance is held, then obviously costs up to the scratch performance as well would actually be eligible, and potentially things like the venue hire for that performance or the rehearsal times can be included in that as well. So it's very interesting because at what point is it a scratch performance or just a glorified dress rehearsal? So there's more you could actually do with that. But the simple answer is yes, from the scratch performance up to curtain up, you should be in the production phase and those costs would be claimable. There might be more claimable than you expect.
Perfect. Okay, well, I think that's it for now. We've gone over the allotted. We're actually gone a bit over our allotted 10-minute time slot. There are still a few more questions, but as I said, guys, you do have Chris's and Barry's details on the screen. So if you want to fire anything to them directly, please do use those details to email them. We will also get in touch with anyone who's asked a question and we've not been able to answer it on this call. But and to those asking, we will also be sending the slides out afterwards, so you can expect those in by this afternoon. So. So thanks very much, Chris and Barry, for taking the time to ask those and being put on the spot and delivering some great answers to those questions. So thanks very much.
Thanks, Cal.
Yeah, fantastic. I just want to touch on something as well. This wonderful thing, this special purpose vehicle, is made special by lawyers and accountants to obviously drive up their costs. It's something we can help with, and we're in actual fact doing a webinar as well. This webinar is going to be next year on the 13th of Jan. I know you can't wait, it's actually 13th of Jan 2026. So we weren't perfect on this. It's 2025. We do try our best. It'll be on the 13th of Jan 2026. It's all about special purpose vehicles, and we will be sharing a lot more information regarding those. But if anybody needs to talk about getting that set up, we have some wonderful templates that we can help and provide to you. Please get in touch. We're here to help. And I think that's about it. So thank you very much for listening. Just to finish off, I'd like to say it's a goodbye from me.
Nice goodbye from me.
Yeah, well done. Thank you, everybody.